Bitcoin is charging toward $1 million, but the American housing market is simultaneously entering what could be the most significant collapse in history.
It sounds like a contradiction, but experts like ARK Invest founder Cathie Wood and macro strategist Jeff Snider say these tectonic shifts are happening right now.
We've utilized advanced AI to distill over 5 hours of deep dive research from 6 top analysts into just a few minutes of actionable alpha.
Stay tuned to uncover the death by 1,000 cuts hitting the oil industry and the specific technical level that could trigger a stock market drop overnight.
The headline for the ARK Invest Big Ideas 2026 report is massive. Cathie Wood is doubling down on Bitcoin, hitting $1 million by 2030.
It is bold, but Cathie Wood's analysis suggests we are moving from Bitcoin as a niche asset to a global monetary system.
Wait, did you say $1 million? Like for a single digital coin? That sounds like a typo.
No typo. Cathie Wood's team is looking at institutional adoption and scaling technology that could drive that valuation.
But while she is ultra bullish on Bitcoin, her report also flags a massive risk for traditional banking that we need to touch on in a minute.
Cathie Wood has spent her career focusing on what she calls disruptive innovation, and this report is the culmination of that research.
So she's basically the expert on things that break the status quo.
Exactly. She thinks Bitcoin is the biggest status quo breaker of our lifetime.
Her perspective is that if you aren't looking at these data points, you're missing the future of finance entirely.
Cathie Wood's core thesis is that institutional adoption will drive Bitcoin to a $10 trillion market cap.
Right, her research shows that even a small allocation from global institutional assets, think 2 to 5%, creates a massive supply squeeze.
Hold on. If the big banks and pension funds start buying, doesn't that just make it another corporate asset?
In a way, yes. But Cathie Wood argues that's exactly what provides the liquidity and stability needed for the $1 million price target.
So the smart money is finally catching up to the internet's money.
And here I am still trying to remember my password.
Cathie Wood emphasizes that Bitcoin isn't just for holding anymore. The Lightning Network is making it usable for everyday transactions.
Her team projects that Lightning capacity could grow 500% as it becomes the backbone for global payments.
Wait, Lightning Network? Is that like a faster version of a credit card?
Exactly. It's a layer on top of Bitcoin that allows for instant, nearly free payments anywhere in the world.
And Cathie Wood's point is that this solves the slow problem that critics always complain about.
So I could actually buy a coffee with Bitcoin without waiting 10 minutes for a confirmation.
One of the most controversial points in Cathie Wood's analysis is that Bitcoin mining is actually good for the environment.
She argues that miners provide a buyer of last resort for solar and wind power, which can increase renewable capacity by 20 to 30%.
Wait, everything I hear says Bitcoin kills the planet. Now she says it saves it?
Her data shows that by using stranded energy that would otherwise be wasted, miners make green energy projects more profitable.
So Bitcoin is basically acting like a giant battery for the power grid.
That's a wild 180 from the usual narrative.
The report highlights that spot Bitcoin ETFs are the bridge that will bring in $1.4 trillion in new demand.
According to Cathie Wood, these ETFs remove the technical hurdles for large funds that were previously restricted from buying crypto.
So it's like an easy button for billionaires.
Essentially, it lets them trade Bitcoin through traditional brokerage accounts like a regular stock.
And when that wall of money hits, Cathie Wood thinks the price impact will be explosive.
I guess the digital gold comparison is finally becoming a reality.
Cathie Wood's bull case for 2030 is even higher than her $1 million base. She's looking at 1.5 million.
That assumes Bitcoin captures a significant portion of the global settlement and store of value markets.
Wait, 1.5 million. If that happens, a Satoshi will be worth more than a penny, right?
It would be a total paradigm shift. We're talking about a world where Bitcoin is a primary global reserve.
So it's not just an investment anymore. It's the foundation.
I really need to find that password.
Even in Cathie Wood's bear case, she sees a floor of $250,000.
Her reasoning is that the institutional support and network security are now too strong for it to ever return to previous lows.
Wait, her worst case is still like 4 or 5 times the current price?
That is the conviction level in the Big Ideas report. She views the downside as limited by the massive network effect.
It's a bold stance, but her data on hash rate and wallet growth supports it.
I wish my worst case scenarios were that profitable.
To follow Cathie Wood's thesis, you need to watch the hash rate. It's the ultimate indicator of network health.
If the hash rate keeps hitting all-time highs, it proves the network is getting more secure and harder to attack.
Is hash rate basically the heartbeat of the network?
Exactly. A strong heartbeat means a healthy Bitcoin.
The other big indicator Cathie Wood suggests is institutional 13F filings.
When you see more and more hedge funds and banks reporting Bitcoin holdings, you know the $10 trillion thesis is playing out.
So I should watch what the big guys are doing, not what they're saying.
Exactly. Watch the wallets, not the tweets.
Got it. Wallets over words. Let's see where 2026 takes us.
Jeff Snider is sounding the alarm again, and this time it involves insights from Texas oil insiders that most of Wall Street is ignoring.
Right. Jeff's core takeaway is that while everyone is obsessed with oil supply cuts, the real story is a massive collapse in global demand hiding in plain sight.
Wait, if there's less oil being pumped, shouldn't prices be sky high? How is the real story that nobody wants it?
That's the alpha here. Jeff argues that the broken Eurodollar system is choking off the global economy so hard that supply doesn't even matter.
And it gets crazier. Later, we'll look at why Jeff thinks even the massive Permian Basin in Texas won't be able to fix this, no matter how much they drill.
Hold on, Texas has plenty of oil. Why wouldn't that work?
Jeff points to a death by 1,000 cuts in infrastructure. But first, let's look at the demand destruction data.
Exactly. The numbers show the global economy is slowing down much faster than the headlines suggest.
Jeff Snider highlights a startling stat. Global demand is actually down 5% compared to pre-pandemic levels in 2019.
And that's despite the recovery narrative. In China and Europe, the numbers are even uglier.
5%? That doesn't sound like much until you realize how many millions of barrels that actually is.
It's huge. It's the difference between a booming economy and a grinding halt.
Jeff attributes this to the Eurodollar system. Basically, there aren't enough dollars moving offshore to finance global trade.
Wait, what's a Eurodollar? Like a digital euro?
No, it's just US dollars held in banks outside the States. They are the oil for the machinery of global trade, and Jeff says the gears are seizing up.
When the dollars stop flowing, countries stop buying oil, regardless of how much they need it. According to Jeff Snider's review of Texas insiders, the cost to drill a new well has spiked by 20%.
It's not just inflation, it's a total lack of specialized labor and spare parts.
20%. So even if the oil is there, it's getting too expensive to even get it out of the ground.
Precisely. If you can't find a crew to run the rig, the oil stays in the rock.
Jeff notes this creates a floor for prices, but if demand falls faster, the industry is in big trouble. Jeff argues the Permian Basin is hitting a physical wall. We've already tapped the easiest oil.
Right. The Tier 1 acreage is mostly gone, now they're drilling Tier 2, which yields less for more effort.
So we're basically scraping the bottom of the barrel? Literally?
In a way, yes, efficiency is dropping, just as costs are rising.
And Jeff says the market hasn't priced in this structural decline in output quality yet. Jeff also points out that we haven't built a major new refinery in the US in decades.
Correct. So even if we had infinite crude oil, we don't have the capacity to turn it all into gasoline.
Wait, so the problem isn't just getting the oil, it's cooking it into fuel.
Exactly. It's like having a fridge full of ingredients but no stove.
Jeff says this refinery squeeze keeps prices high for you and me, even if crude prices drop. Jeff Snider predicts that the shortage of Eurodollars will lead to defaults in emerging markets that rely on energy imports.
Countries won't be able to pay their debts and buy fuel at the same time. Something has to give.
So we're talking about entire countries going broke just to keep the lights on.
That's the worst case scenario Jeff is warning about. It's a systemic failure.
Despite the supply issues, Jeff thinks oil could drop to $40 or $50 if the global recession hits hard enough.
It sounds counterintuitive, but if no one is driving or shipping goods, supply doesn't matter.
$40? Gas would be cheap, but I guess I wouldn't have a job to afford the drive anyway.
That's the trade-off. Jeff says don't cheer for low oil prices when they're caused by a broken economy. Jeff Snider suggests keeping a very close eye on the US dollar index, or DXY.
When the dollar gets too strong, it usually means Eurodollars are disappearing. That's bad for everything.
So a strong dollar is actually a warning sign for the global economy.
In this specific context, yes, it's a signal that liquidity is drying up.
He also mentions the inverted yield curve. Jeff says it's the most reliable check engine light for the economy.
If the curve stays inverted, the demand destruction Jeff is talking about is only going to get worse.
Yield curves, DXY. I'm starting to think Texas oil is more about banking than actual oil.
According to Jeff Snider, it's all the same system. You can't have one without the other. Matt deWolf from Trade Brigade is making it very clear. The markets do not care about the war right now. We're looking at an S&P 500 that's holding firm at 5,800.
It's all about earnings season now. The geopolitical noise is being drowned out by big bank balance sheets.
Wait, so you're telling me with everything going on globally, traders are just looking at bank statements?
Essentially, yes. Matt points out that unless the price action breaks, the bulls are still in control.
Matt deWolf's analysis suggests that the pivot to earnings is the only thing that matters for the next 3 weeks.
Exactly. We're moving from macro fear to micro fundamentals.
So instead of watching the news, I should be watching the tickers for JP Morgan and Wells Fargo.
According to Matt, that's exactly where the alpha is hiding right now.
The core thesis from Matt deWolf is that we are in a no-landing scenario, as long as the S&P 500 stays above 5,750.
He's watching that level like a hawk. If it holds, we're looking at a path to new all-time highs regardless of interest rates.
Hold on, no landing. Does that mean inflation just stays and we keep flying?
It means the economy stays hot enough to support these high valuations without crashing.
And Matt's technical setup shows that the buyers are stepping in every time we dip toward that support. Matt deWolf highlighted JP Morgan and Wells Fargo as the bellwethers for this entire quarter.
The numbers are solid. Higher for longer interest rates are actually helping their net interest margins.
Wait, I thought high rates were bad for everyone.
Not for the banks. They're raking it in while the consumer is still, surprisingly, paying their bills.
Matt notes that if these banks didn't tank on the news, it's a huge green light for the broader market.
So if the big banks are happy, the S&P is happy.
Moving to tech, Matt deWolf is focused on Nvidia hitting that $140 resistance level.
140. It feels like it was just at 100 last month.
It's the AI momentum. Matt thinks if it clears 140, it's blue skies ahead.
But he also warns that the RSI is getting a bit toasted. It might need a breather before the next leg up.
Or a sigh. Is that the thing that tells you if people are buying too much?
Exactly. It's basically an exhaustion meter, and NVDA is running hot.
Matt also pointed out the IWM, the small caps. They've been the laggards, but they're testing $225.
Why do we care about the small guys if NVDA is doing all the work?
Because a healthy market needs breadth. If small companies start winning, it means the whole economy is participating, not just the tech giants.
Matt believes that if IWM breaks through, it could be the catch-up trade of the year.
So buy the little guys, because the big guys are already too expensive.
In Matt's view, that's where the next 20% move might come from.
Matt deWolf is predicting a year-end target of 5,900 for the S&P 500.
That's a pretty bold call, but with earnings coming in strong, the momentum is there.
Wait, so we're just going to keep going up forever? No crashes?
Not forever, but Matt's chart analysis doesn't show any major sell signals yet.
He expects a melt-up as fund managers chase performance before the year ends. Another prediction from Matt, once the election uncertainty clears, the VIX will drop below 15.
That would mean the fear index is basically dead. Calm waters ahead.
So the war and elections are just temporary hiccups for the VIX.
According to Matt, the market has already priced in the chaos. What's left is just the relief rally.
Matt deWolf's main takeaway: buy the dips as long as we are above 5,750.
It's a simple trend-following strategy. Don't fight the tape.
So if it drops to 5,760, I buy?
That's the plan. It's the line in the sand for the bulls.
Lastly, Matt suggests keeping an eye on the VIX. If it spikes above 20, the thesis changes.
Above 20 means the party's over.
It means the risk is rising. Matt uses it as his early warning system.
But for now, the signal is clear. Stay long and watch the earnings. Today we're dissecting a massive warning from Nick Gerli of Reventure Consulting about what he calls the biggest housing collapse in U.S. history.
Nick's recent data shows inventory levels are exploding in key regions, which usually signals a major price correction is about to hit.
Wait, biggest in history? Like worse than 2008? That sounds like a lot of hype.
Nick isn't just throwing numbers around. He's looking at the National Association of Realtors data, and it's looking grim.
Nick Gerli believes the recent NAR settlement over commissions is the final domino to fall in this cycle.
Exactly. And while the inventory surge is the headline, the structural shift in how we buy and sell homes is the real alpha insight here.
Wait, what does a legal settlement have to do with my house value?
We'll get into that bombshell shortly, but first, we need to look at why the South is currently leading the race to the bottom.
Nick Gerli points out that inventory in states like Florida and Texas has surged over 40% year over year.
That's a huge shift. When supply jumps 40% and buyers are sitting on the sidelines, prices have nowhere to go but down.
Hold on, 40%? I thought there was still a housing shortage.
Nick argues that the shortage narrative is dead in the Sunbelt. Sellers are rushing for the exits while buyers are priced out.
It's a classic supply-demand imbalance that Nick thinks will spread nationwide.
So much for my Florida vacation home dreams.
Nick Gerli's analysis of the NAR settlement suggests that decoupling commissions could lead to a 5 to 10% drop in effective home prices.
Right? Because sellers won't have to bake a 6% commission into the asking price anymore.
Wait, so I don't have to pay my agent 6% anymore? That sounds like a win.
It's a win for your wallet, but Nick warns it could cause a sudden repricing event that shocks the market.
It's basically a massive liquidity drain for the real estate industry.
So the agents are the ones sweating, but my equity might be at risk too.
Nick highlights that housing affordability is at a 40-year low, making it impossible for the average family to buy.
With mortgage rates still hovering near 7%, the monthly payment on a median home is up over 50% from 3 years ago.
50%? No wonder everyone I know is still renting.
Exactly. Nick's data shows that buyer demand has essentially flatlined.
And when demand stops but inventory keeps growing, you get the collapse Nick is predicting.
So we're just waiting for the sellers to blink.
Another point Nick Gerli emphasizes is that institutional investors are starting to offload properties.
They see the writing on the wall. If the yield on a rental house is lower than a treasury bill, they're out.
Wait, so the big guys are dumping houses now too?
According to Nick, yes, especially in markets where Airbnb demand is softening.
When the smart money sells, it usually means the floor is about to drop.
This is starting to feel very 2008-ish.
Nick predicts a 15 to 20% price drop in major Sunbelt markets over the next 18 months.
He bases this on the fact that inventory levels have already surpassed pre-pandemic levels in places like Austin and Tampa.
20%? That's a massive chunk of someone's savings.
It is, but Nick argues those prices were artificially inflated by 0% interest rates anyway.
It's a return to reality, but it's going to be a painful one for recent buyers.
Glad I didn't buy that condo in Austin last year.
Nick also warns of a market freeze where transactions plummet before a wave of forced selling begins.
We're already seeing the freeze. Volume is at its lowest level since the mid-90s.
Lowest since the 90s. But our population is way bigger now.
That just shows how broken the current market is, according to Nick's analysis.
Eventually life happens, divorce, job loss, and people have to sell. That's when the prices truly tank.
So the inventory explosion is just the beginning.
Nick Gerli suggests investors and homebuyers track the inventory to sales ratio in their local zip code.
If it crosses the 6-month supply mark, you're officially in a buyer's market.
So, I should check Zillow for how long houses are sitting.
Exactly. Days on market is your best friend right now. Another actionable tip from Nick: monitor the percentage of listings with price cuts.
In some Florida cities, over 30% of listings are already seeing cuts.
30%? Okay, so the sellers are starting to blink.
They're blinking hard. Nick says that's your signal to wait for a better deal.
Patience is the name of the game in this housing cycle.
I can do patience if it saves me $100,000.
Today we are breaking down a deep dive from Chris Vermeulen, the technical analysis pro, and host Craig Hemke. Chris is saying markets are basically in a holding pattern before a massive move.
Right. Chris has been tracking cycles for decades, and he's seeing signs that this quiet market is about to get very loud.
Wait, if it's quiet now, does that mean it's the calm before the storm? I usually hate storms when it comes to my money.
Exactly. While stocks are hitting a ceiling, wait until you hear Chris's target for gold. It is way higher than where we are now. Chris Vermeulen points out that the VIX, or the fear gauge, is sitting right around 12. People are way too relaxed.
Historically, when the VIX drops that low, it means a spike in volatility is just around the corner. The market is like a coiled spring.
Hold on, 12? Is that like a record low or something? Why aren't people worried?
It's not a record, but it is low enough to suggest that everyone thinks the coast is clear. And Chris says that's exactly when things break.
So we're all just standing on a trapdoor, and nobody's looking down.
Terrific. I'll just go ahead and put my helmet on now.
Chris notes, the S&P 500 is basically running into a brick wall, right at the 5,000 mark.
Yeah, he mentions that volume is drying up at these highs. There just aren't enough buyers left to push it through that ceiling.
Wait, 5,000? Is that just a psychological limit, or is there actually a reason for it?
It's both. It's a massive round number where traders like to take profits, and Chris's charts show a lack of momentum to break it.
So the big players are basically packing their bags, while retail investors are still arriving at the party.
Typical. I'm always the guy showing up with the chips right when the music stops.
Craig Hemke and Chris discussed gold testing, that crucial $2,100 level. It's been a hurdle for a long time.
If it breaks through, Chris sees a clear path upward. He's looking at a massive cup and handle pattern on the long-term charts.
Cup and handle? Are we talking about T-sets or my retirement fund?
It's a bullish chart pattern, and Chris says it indicates that once gold clears 2,100, the sky's the limit.
So gold is basically the backup plan for when stocks start to wobble.
I've always liked shiny things. Maybe it's time to trade my tech stocks for some bars.
Interestingly, Chris is recommending a heavy cash position right now, around 40 to 50%.
He calls this market choppy and says sitting on your hands is often the most profitable move.
Wait, half my money in cash? Isn't inflation going to eat that alive?
Chris argues that losing a few percent to inflation is better than losing 20% in a market crash while you're waiting for a setup.
So it's about having dry powder to buy the dip when it finally happens.
Dry powder? Got it. I'll just keep my cash in a metaphorical dehumidifier then.
What's the downside risk? Chris Vermeulen warns we could see a 5 to 10% pullback in stocks very soon.
He's seeing bearish divergence on the indicators, which usually means the price is making new highs, but the momentum isn't following.
Wait, 5 to 10%. That doesn't sound like a crash, but it's enough to hurt, right?
Exactly. It's a correction. For some, it's a disaster. For Chris, it's just a cycle resetting.
So if the S&P 500 drops to 4,500, is that a buying opportunity?
Or is it just the first floor of a very tall basement?
On the brighter side, Chris's technical target for gold is $2,400.
That is based on the measured move from the breakout of this current base. It's a pretty standard technical target.
2,400. That would be an all-time high, wouldn't it?
Way past it. And Craig Hemke adds that if the dollar weakens even a little, that move could happen fast.
So while stocks are struggling with their ceiling, gold is looking for a new floor.
I'm starting to think gold might be the only thing in my portfolio that doesn't keep me up at night.
Chris Vermeulen's main takeaway: watch the 20-day simple moving average.
If the price closes below that line for 2 days, he says that is your signal that the trend has officially flipped bearish.
The 20-day what? Can I just find that on a normal chart, or do I need a degree in math?
Most apps have it. It's basically the average price of the last 20 days. Think of it as the market's pulse, and keep an eye on the VIX. If it jumps above 15, the limbo period is over.
That's when the real volatility kicks in, and we see those 5 to 10% moves Chris is talking about.
So if the fear gauge goes up, it's time to move, or time to hide.
According to Chris, it's time to use that 50% cash to buy the things that are actually on sale.
Buy low, sell high. Simple enough, if only my emotions would agree.
Today, we are looking at a deep dive from Lance Roberts, the chief investment strategist at RIA Advisors, regarding why this market rally might be a massive bull trap.
Lance joined Adam Taggart on Thoughtful Money to explain that while the indexes look great, the foundation is actually incredibly brittle.
Wait, brittle? Like if I poke the S&P 500 too hard, it just shatters?
Basically, Lance argues that a few giant tech stocks are doing all the heavy lifting, while the rest of the market is essentially flatlining.
The alpha here is that Lance thinks we are in a momentum-driven mania that ignores the lagging impact of high interest rates.
So it is like a party where everyone is dancing, but the music actually stopped 10 minutes ago?
Exactly. And while we break down the bull trap risk, stick around because Lance also reveals a specific technical level that could trigger a 5 to 10% drop overnight.
Let's get into the data Adam and Lance discussed. Lance Roberts points out that the top 10 stocks now represent over 30% of the S&P 500's total weight.
That is the highest concentration we have seen in decades, even surpassing the dot-com bubble levels.
Hold on, 30%. So if just 10 companies have a bad day, my entire retirement account takes a dive?
That is exactly the risk Lance is highlighting. It is not a broad bull market. It is a big tech bull market. One of the biggest points Adam and Lance discussed is the interest rate lag, which usually takes 12 to 18 months to fully hit the economy.
We are right in that window now. Lance notes that while the Fed stopped hiking, the pain is just starting to filter through to corporate earnings.
Wait, so you are saying the interest rate hikes from a year ago are only just starting to hurt businesses now?
Exactly. It is like an iceberg. You only see the tip, but the massive part underneath is what sinks the ship.
And do not forget the consumer. Lance highlighted that total household debt has hit a staggering $17.5 trillion.
17 trillion. I feel bad about my credit card balance, but that is next level.
It means the average person has zero cushion left if the job market starts to soften, which Lance sees as a growing risk.
When consumers stop spending to pay off debt, corporate margins collapse. It is a simple, ugly chain reaction.
On the technical side, Lance is seeing a massive divergence where prices are hitting new highs, but the relative strength index, or RSI, is falling.
That is a classic sell signal. It means the momentum is fading, even as the price creeps up on low volume.
So, the market is basically running on fumes at this point.
Fumes and hope, mostly. Lance warns that when that RSI breaks, the trap snaps shut.
Lance predicts a mean reversion correction of at least 5 to 10% in the coming months.
He expects the S&P 500 to test its 200-day moving average as reality sets in regarding earnings growth.
5 to 10% sounds painful. Is that get out of the market territory, or just stop looking at your app territory?
Lance suggests it is a protect your gains territory. If we break below that moving average, the downside could get much worse.
Looking further out, Lance told Adam that a formal recession is likely to manifest by late 2024 as unemployment finally ticks up.
He bases this on the yield curve inversion, which has a 100% track record of predicting downturns.
Wait, 100%? Why is everyone not panicking then?
Because the lag makes people think this time is different. Lance's data says it rarely is.
So what is the move? Lance suggests rebalancing your winners and moving some capital into cash or short-term treasuries.
Right? Do not sell everything, but do not be the last person holding the bag when the momentum shifts.
So, basically, take some chips off the table while the house is still paying out.
Exactly. Cash is a position, and right now it is a safe one according to Lance's analysis.
Lance also recommends watching the 20-day moving average. If the market closes below that for 3 days straight, that is your exit cue.
20-day average. Got it. I will start drawing lines on my charts immediately.
Smart. Following Lance Roberts' data-driven approach is better than following the hype.
Stay cautious out there. The bull trap is set.
To kick things off, Cathie Wood argues that we are on the brink of a $10 trillion opportunity due to groundbreaking innovations.
And that's bold. She emphasizes that sectors like AI and biotech are going to revolutionize everything.
So basically, if you want to get rich, just invest in the future, right?
Well, it's not that simple, but she definitely sees a bright horizon. Next is Jeff Snider, who warns about demand destruction being a major hurdle.
Absolutely. He explains that declining consumer demand can lead to a deeper economic downturn.
So it's not just about inflation. We also have to worry about people not spending money.
Exactly. It's a vicious cycle that's hard to break. Then we have Nick Gerli, who discusses an impending inventory tsunami in the housing market.
Right. He believes the surge in property listings will drastically change supply and demand dynamics.
Wait, so the housing market might collapse because too many homes are for sale?
Well, that's one scenario he lays out, yes. What's fascinating is that all three guests agree this is a transformative period for the economy.
Right? Whether it's through innovation, demand issues, or housing dynamics, they're all seeing a major shift.
So no one's arguing that change is coming, just how it will unfold.
Exactly. It's more about the nature of these changes and how quickly they'll happen. Cathie and Nick both touch on how housing trends will dictate much of the economic conversation moving forward.
Yes, Cathie sees innovation driving growth, but Nick argues that housing inventory is the key player.
So is housing the first domino in this entire economic puzzle?
That's a fair comparison, and both believe it leads to significant market implications. Here's where it gets interesting. Cathie champions innovation as the way forward, but Jeff warns that demand destruction could derail everything.
Totally. Cathie sees the glass as half full with innovation. Jeff, on the other hand, sees it as half empty if consumers stop spending.
So it's a classic optimistic versus pessimistic debate.
And both perspectives are valid, given current economic signals. And then there's Nick versus Jeff on housing. Nick predicts an inventory explosion, while Jeff's skeptical about housing being a main driver.
Right. Jeff believes that the fundamental economic challenges could counteract the surge.
So Nick's seeing opportunity, while Jeff sees risks.
Exactly. It's all about how they interpret the data. If you enjoyed this insightful breakdown, give us a thumbs up and subscribe for more in-depth analyses.
We're here to sift through the noise and deliver you key insights without the hassle.
Trust me, this series has saved me a ton of time. I'm hitting that subscribe button.
Great. We look forward to seeing you in the next video for even more expert insights.